Good evening and welcome back again to Global Associates video lecture series on technical aspects in accounting. Today, I'm planning to take one question from ACCA SBR, basic question as to how we prepare a statement of financial position. Now, we have to prepare the consolidated statement of financial position of a given scenario. So, in that, let's go through the question. The statement of financial position for the two entities for the year ended 31st December 2009 are given below. So, presented below. Statement of financial position as on 31st December 2009. Non-current assets, investments in subsidiary, they have given a note on that. And then we have that property, plant and equipment, investment in subsidiary, current assets, equity, share capital, retained earnings, non-current liabilities, current liabilities. And additional information have been given. Brown acquired 60% investment in Harris on 1 January 2006 for 720,000 when the return earnings of Harris were 300,000. On 30th November 2009, Harris sold goods to Brown for 200,000, one quarter of which remained in Brown's inventories at 31st December. Harris earns 25% markup on all items sold. An impairment review was conducted at 31st December 2009 and it was decided that the goodwill on acquisition of Harris was impaired by 10%. Prepare the consolidated statement of financial position for the group as of 31st December 2009 under the following assumption. It is the group policy of to value non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest at 1 January 2006 was 480,000. It is group policy to value non-controlling interest at the proportionate share of the fair value of the net asset at acquisition. Now today I will be taking the requirement section A. I will discuss the section B in a different video in order to limit the time constraints in the video. So let's move on to the question now. In approaching such a consolidated financial consolidated statement of financial position, before we prepare the final answer, what we should do is we have to have some working. First working is the group structure. We need to draw the group structure. That will be the first working. So we have to work out the group structure. So let's go through the question again. Brown acquired 60% of investment in Harris on 1 January 2006 for 720,000. So Brown invested on Harris 60%. And investment cost is 720,000. And the return earning at the date of acquisition was given in the question. Return earning at the date of acquisition is that 300,000. The return earning at the date of acquisition is 300,000. So return earning 300,000. So that is one other information, and also they gave you NCI has been valued according to, now when we preparing a consolidated financial statement, we should follow the requirements of IFRS 3 and IFRS 10. We have to follow the requirements of IFRS 3 and IFRS 10 when producing a consolidated financial statement or consolidated statement of financial position. So, according to IFRS 3, to value NCI, they have discussed several methods. One of the methods is to take the lump sum. In that basis, the lump sum that is given in the question is 480,000. So that is given. So with this information, we can now produce the consolidated, what you call, we have to work out the goodwill calculation of goodwill. So in working out the goodwill, we have to take the fair value of purchase consideration. Fair value of purchase consideration. In other words, the investment amount made by the parent to the subsidiary, which is 720,000. And the fair value of NCI. Fair value of NCI is 480,000. Now we can take the total of these two. So to take the total of these two, we will go to the calculator. So 720 plus 480. I'm getting 1,200. So 1,200,000 minus the fair value of identifiable net assets at the date of acquisition. Identifiable net asset at the date of acquisition of the subsidiary. So we will take that. So what are the net assets of a subsidiary will be basically the share capital of the subsidiary as per the question. So we go on to the question and look for the share capital of the subsidiary that you can see here 500,000. So we take that. So 500,000 and we have to take the return earnings at the date of acquisition that we have found out in our first working. When we are drawing the group structure, we found that out. So the return earning at the date of acquisition is 300,000. So let's work that out. So we will bring it that down. So that is 300,000. So let's find out any other relevant information available for the purpose of calculating the goodwill. They said that that acquisition and they also gave you the investment. Investment is 720,000 and return earnings of that also given at the date of acquisition. Very fine. And they also talk about the provision for unrealized profits that we will do it as a separate working that is not relevant to our goodwill calculation and the impairment. So with that information, we can now continue the question. So anyhow, so the total of these two is 800,000. So when you subtract 800,000 from 1,200,000, I'm getting 400,000. This is the goodwill. According to IFRS 3 basis of calculating goodwill, this is the goodwill that we are getting minus impairment. Impairment is 10%. 10% of this 400,000 will be 40,000. So the remaining goodwill is 360,000. This is the working number 2. The working number 2 is calculation of goodwill. Third working, provision for unrealized profit. Provision for unrealized profit is the third working. Now what they are saying here? Now what they are saying here is that on 30 September 2009, Harris is the subsidiary selling goods to Brown is the parent. This type of sales is known as upstream transaction, one quarter of which remain in Brown's inventories at 31st December. Harris earns 25% markup on all items sold. So 200,000. Now Harris is selling goods to Brown. So the selling worth of the selling price is 200,000. So 200,000 is there. And they said that of that, what is the remaining stock in the inventory? 1/4. 1/4 is remaining. So that is 1/4. So the 1/4 is 50,000. And the way they priced it, the profit is 25% markup. So this 50,000 is then the profit on this will be 50,000 into 125 into 25 divided by 125. So let's work out this and calculate it using the calculator. So what that says? 50,000 into 25 divide by 125. So that is 10,000. The 10,000 is the known as unrealized profit. So what we have to do is we have to adjust the inventory. Inventory should be reduced by 10,000 and the group profit should be reduced by 10,000. Now remember, this 10,000 belongs to both parties, group as well as NCI, based on the acquisition percentage. Now acquisition percentage, if you see the group working 60%. So of this 60%, 6,000 and 40% should be adjusted to NCI 4,000. Now with this working, we can now continue with consolidated retained earnings. We can do that working now. Now we have the parent is B and the subsidiary is H. As per question, give me a minute. Okay. So as per question, we will find it out. The retained earning as per question of the parent 3,430. So that is retained earning of the parent and the subsidiary is 1,800. Let's take these two numbers. 3,430 and 1,800. And we subtract pre-acquisition return earning. The pre-acquisition return earning, what the return earning we have taken to calculate the goodwill, we have to take it. That this number. You have to take that number and remove it from this calculation here. So 300,000. So this is the post-acquisition. On the post-acquisition, we have 1,500 there. Of that, we have this unrealized profit 10. We remove that. As well, we have this impairment of goodwill. The impairment of goodwill also that we have, how much was that? 40,000, and that 40,000 we can take it, remove it from here. So 1,450 will be the post-acquisition remaining. So we from this balance transfer to group. Transfer to group, I have to transfer 60% of this 1,450. 1,450 into 60% will be 870. I will be transferring to the group. And the balance transfer to NCI, that will be 1,450 minus 870, 580. That is to NCI. And if you subtract this now, you should get 0 here. And let's take the total. So 3,430 plus 870. 3,430 plus 870. 4,300. 4,300 will be the consolidated retained earnings. And then we will go for working of NCI. NCI at acquisition would be the value that we have placed in the goodwill calculation. So that value is this. So you have to take that value here down. But here you will take that 480,000. And post acquisition, that is 580. If you take the total, this will be NCI at balance sheet date. So how much is that? 480 plus 580. 1,060. With this, we can now prepare the consolidated statement of financial position. So now in preparing that, we can follow this. We should follow the same format as per the format given in the question. With the names and all that, statement of financial position, consolidated statement of financial position as at whatever the date. What is the date given in the question? 31st, when is that? 31st December 2009. So that's the date we have to look for. 31st December 2009. Assets, non-current asset, under that what we have?